What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
Hey guys, it's Hamish here, and we're back with another interview reaction video. And today, of course, we're looking at another Warren Buffett interview. I really like Warren Buffett's interviews. I think he does such a great job at explaining key components of his strategy, and especially in this one, in the Fortune interview that we're going to be talking about today, and I'm going to be showing you today. He goes in depth into some components of his strategy, which is really useful for beginner investors and people who have been investing for a little while. So I'm excited to share with you my thoughts on some of the things that he says during this interview. If you do enjoy the video, make sure you leave a like and let me know your thoughts down in the comment section below. But for now, guys, let's jump into it.
At any rate, what I'd like you to do is spend a paragraph or two talking about what, by Buffett standards, is a good business, and then go into why does the car dealership business look like a good business to you?
A good business is the one that earns a high rate of return on tangible assets.
Very simple.
That's pretty simple, yeah. And the very best businesses are the ones that earn a high rate of return on tangible assets and grow. But even ones that don't grow, if they earn a high return on tangible assets, and then of course if you don't pay too much, they can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right. Now the big mistake which we made in the early years was to try and buy a bad business at a really cheap price, and it took me about 20 or 30 years to figure out that wasn't a good idea.
A good business is one that earns a high return on capital, and a great business is one that earns a high return on capital as well as growing equity over time. Now, this is the exact same philosophy that Warren Buffett has been preaching for many years. It's really simple, and it's simple for a reason. It doesn't need to be complicated. It's just those two components. What is management doing in order to invest small amounts of capital and produce a high return on that capital? And also, what is management doing in order to grow the equity of the business over time? If you can find a company that consistently produces 15 or 20% returns on their capital over the very long term, so not just over a short period, they've consistently done this over many years, and they sort of appear to be getting more efficient at that. They're getting a higher return as time has gone on. And if that company is growing equity at a substantial rate, if you can buy that at a great price, you're going to do very well over time. Those are the two main components that Buffett continuously reiterates that investors should be focused on.
But this is the car business, the car dealership business, if run well, can be a very good business. You have no receivables to speak of. You floor plan your inventory. You can lease your real estate. We don't do that. We'll own 95% of our real estate. So you can have very little capital actually invested in the business. And you do a large volume. Van Tile, which we bought, has 78 dealerships. They'll average over $100 million a dealership. So you can work on fairly narrow margins and still earn a high return on capital if you don't tie up much capital into $100 million of business.
And how many car dealerships are there in total in the United States?
Well, there are over 17,000 car dealerships in the United States. And the interesting thing is, if you go back 40 or 50 years, there were in the 30,000. So while the country has grown dramatically, and actually the number of nameplates in the car business have grown, you've cut the dealerships almost in half. So the average dealer now does far greater volume than when I was growing up.
And that right there is why Buffett is such a great investor. He doesn't have any tricks or secret formulas that he's using. He just understands the businesses that he invests in back to front. He completely understands them. And that sort of little explanation about the car industry, about the auto industry and the dealership industry shows his knowledge about that industry and why he's investing in it. He's talking about specific things and specific characteristics that are unique to auto businesses. You can't just apply a blanket formula to every single business. There's specific things about different businesses and unique aspects about different industries that are specific to those industries, and you need to learn about those things. Your understanding of those industries and those businesses, how deep your understanding goes, will help you answer those two major questions. is it a good business, and how much it's worth. And that's all you really need to do as an investor.
Well, we'll get out of it somehow because I always say that buy stock in a business that's so good that an idiot can run it because sooner or later one will. Now,
this is just another reason why it's a very smart move to just invest in really simple businesses, industries that are easy to understand and industries that are growing. If you're investing in an industry or a company that has trends that are negative, so the industry's shrinking and the business is also losing sales, then it's going to take a hell of a good management team in order to turn that around and in order to grow a business in a shrinking industry. And while a dodgy company in a dodgy industry might have an all-star management team right now, the investing style that we're taking means that we're going to be investing in these companies for many, many years. So there's going to be some point in the future in which there's going to be a less than all-star management team running this company. And if they're less than all-star and the company is in an industry that's shrinking and the company itself is really not that great, then over time, you're not going to make a profit on that investment.
Jenny Johnson with Franklin Templeton Investments. How do you know when to throw in the towel on an investment or a business?
when you throw in the towel on
On investment or business.
or business, yeah, well, what you know is you do it too late. I went in the textile business by accident in 1965, and I threw in the towel about 20 years later, and that was about 20 years too late. There's a great tendency to want to hold on, justify old decisions. I mean, that's a human trait. And when you really know you've got a bad business is when you have a good manager and you're getting bad results. I mean, when you're getting bad results with a bad manager, you still have to examine the question of whether you can get better results if you get a better manager. Usually you can't. I've said in the past, that when a management with a reputation for excellence encounters a business with a reputation for bad economics, it's the reputation of the business that remains intact. And I've proved that many times. There are businesses that are just plain tough, and there may be too many competitors, but there's reasons why they don't drop out. There's reasons. Well, we started out in textiles, and we made over half of the linings for men's suits in the country. And we went through World War II and got awards, and Sears Roebuck named us their supplier of the year and all of that sort of thing. And then we'd say, well, we'd like to increase the price of these linings a quarter of a cent a yard. And Sears would say, you must be out of your mind. There's 10 other guys that will sell it to us at the old price. And nobody ever went into a Sears store and said, I'd like a blue serge suit with a half-away lining. It didn't exist. We had no connection to the consumer.
There's a couple of interesting things that Buffett actually says here. The first one sort of relates to the psychology of investing, and it's that it can be very, very hard to let go of a bad investment decision in the past, especially if you're down on that position. It seems to be some kind of psychological condition or trait in the human condition that means that we want to justify sort of bad decisions in the past so that we can feel better about ourselves in our current position. And the second thing that he says that's really interesting is that sometimes a business is just bad regardless of the management. Sometimes the business itself is bad. And he talks about his experience in the textile business. And I found this really interesting because the textile business and what he was making, the lining of suits, it had no sort of connection with the consumer. And what he was talking about here is actually economic moats. He's talking about wide economic moats. Since the consumer didn't care who made the lining within the jackets, they had no advantage over other companies in that industry, and they could only compete on price. And when you have companies that are only competing on price, companies in that industry are going to make zero profit. That's just the nature of sort of a perfectly competitive market in economics. That's just the nature of how it works. You need to have some kind of wide economic moat that makes your business stand out against its competitors so that consumers want to buy your product because it's your product, not just because it's the cheapest one that's available. And this again comes back to understanding the business. If you don't understand the business, you won't understand how sort of products compete in that market. You need to know whether or not they're competing directly on price, or what kind of advantages your company has over other companies, or what advantages the other companies in the industry have over your company. All of this comes back to understanding of the industry, and it's really simple. You just have to go really, really deep into understanding every little aspect about the businesses and the industries you want to invest in.
And there are lots of lousy businesses, and there's lots of wonderful businesses. And my job over the years has been to try and figure out which is which, and I've made plenty of mistakes. I bought a company called Dexter Shoes.
The job of the investor is simply to work out what is a good business and what is a bad business. And this, you're not going to get this perfect. You're always going to make bad decisions throughout your lifetime when investing in the stock market. Even Buffett concedes that he's made a number of different mistakes in the past. He said earlier in the interview, actually, I'm not sure if I'm going to include that clip, but he said earlier in the interview that it took him nearly 30 years to figure out that it's better to buy really great businesses at a reasonable price than to buy bad businesses at a dirt cheap price, because that's kind of the style that Benjamin Graham followed and Buffett followed in his early years, which was to do what he called cigar butt investing, which is where you buy really, really bad businesses for less than the value of their tangible assets. And he did this for a while, but he realized that that's not a way to be successful over the long term. The way to be successful over the long term is to find the greatest businesses and buy them at a price that is going to ensure that you're going to make a satisfactory return.
I think the other half of the question was about investments. Do you have any rule of thumb about when you give up on or when you realize that?
Well, again, I love it when the things we buy go down. I get euphoric. The stocks are down today, and I'm buying more of something I was buying yesterday. I'm buying it cheaper. Now, when you go to the grocery store and you buy something cheaper than you bought it the day before, you think that's terrific. But people with their stocks, they think that the stock knows more than they do. So that when the stock goes down, they say the stock is telling them something, and what's telling me is I can get more for my money. but they take it as kind of a referendum on themselves, and it's me versus the stock. If it ever gets back to what I paid, I'm going to sell it. The stock doesn't care what you paid. You have to remember, the stock doesn't even care that you own it. You are nothing to the stock. That stock is everything to you, And you remember you paid $10.13, and therefore the stock should get to $10.13 before you sell it. The stock has no feelings about you. I hate to disillusion you on this, but it just doesn't care. And so the only question with every stock, every day, and you don't do it this frequently, is can I get more for my money someplace else? You've got a chance to be in thousands and thousands of great businesses, and their prices change all the time, so their relative valuations change. And you can make the exchange at very low cost these days. Commissions are nothing. So you can always shift from one business to another. You have a huge advantage over Andrew Carnegie. When he was in the steel business, he was in the steel business, or Rockefeller was in the oil business. He could not shift over immediately to retailing or something like that. You can rearrange your business empire, which you own through that little portfolio that you have. You can rearrange that at a moment's notice with practically no cost. It's a huge advantage, which people turn into a disadvantage. There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
This is probably my favorite part of the interview, and probably the most useful part of the interview. He says that the stock doesn't care what you paid for it. The stock doesn't even care that you own it. There's really there's only two questions that you should be asking with every stock. How much does it produce relative to, or how much will it produce in the future relative to what it's selling for? And can I get a better return somewhere else? So you might be down 50% on a position and you don't want to sell it. You don't want to cut your losses, and you want to hold on to it until you make a profit. And that's fair enough. But what you need to do is you need to have a look at the business. If the business's value, or how much cash it can produce you in the next 10 years, has come down dramatically over the past year. So the future prospects of the company have come down dramatically, and there are other companies selling on the market at prices that are going to give you a better return, then you would probably want to reallocate some of that money out of the underperforming stock, out of the stock that doesn't have great future prospects anymore, into a stock that does have great future prospects. The market doesn't care what you paid for it originally. It doesn't care what return you're at. You just, at any point in time, you have a particular amount of money in a particular business. If there's another business that you can move that money into to get a better return, it doesn't matter what's happened in the past. It doesn't matter if the stock has gone down 50% in the past. If from this point onward, there is a different stock that offers a better return, then you will want to move your money into that stock. Now, you've got to be careful here. You don't want to fall into the trap of thinking, my stock has fallen, therefore I need to sell it and move into another investment. That's not necessarily true. This all comes down to value. You need to be able to calculate how much cash a business is going to produce for you. And if with that 50% drop in the stock price, the amount of cash that a business can produce for you has also fallen dramatically, then you would want to look for other opportunities. But if the amount of cash that a business can produce for you hasn't changed, but the stock price has come down, you might want to add to that position. So that's the distinction that you want to make. And I think this is a really, really important part of the interview from Warren Buffett. The thing is, because we're not investing hundreds of millions or even billions of dollars into the stock market, if we want to pivot out of a position into another position that's going to offer better returns, then we can do it pretty quickly and pretty cheaply. It doesn't cost you too much to make that move. For big funds, it costs hundreds of thousands of dollars to make that move, so their hands are a little bit more tied. We have a lot more flexibility as retail investors, and if we find a better opportunity somewhere else, we can quickly move our money into that position. So that's all we've got from this interview today. I hope you enjoyed this one, and if you did, make sure you leave a like and let me know your thoughts down in the comment section below. But I hope you guys have a great day, and I'll see you in the next one.